Hello, financial accounting students. This video clip will be reviewing the treasury stock, the buyback shares transaction analysis with the journal entry of transaction and TAccount and the balance sheet and income statement. Okay, the journal entry, the transaction of the journal entry at the January 5th is my company raised $1 million through common stock. The par value of common stock is $1 and the issued market price is $10. So we have to consider the additional paid in capital. And then authorized shares were 10 million. So the debit account the company issued and the raised amount is $1 million. $1 million. And then the common stock for the par value, how to get it? $1 is par value times how many shares the company issued. Again, the raised amount is $1 million and divided by the issued market price $10 so that we can calculate the common stock par value. So $100 is additional paid in cap, the common stock. Then the difference is additional paid in capital. The raised amount $1 million and $100,000 is common stock par value. So the epic now the common stock we should record 900,000. Then June 30, in order to avoid a takeover try, my company repurchased 10,000 shares at $11 per share from the market. That is the original cost. The company repurchased from the market for 10,000 shares. So, as we discussed in the class, the treasury stock is contra account that reduce equity value. That's why we record the treasury stock on the debit account. So how much is that? Okay, 10,000 shares times $11 original cost. Then the company pay the cash the same amount. Oops. Cash amount $110, $10,000. Now the September 30, no longer threatened by the takeover try, my company resold the treasury stock of 2,000 shares at the market value of 15 per share. Now, how do you record this transaction? 2,000 shares, now we resold this repurchased share to the market. So, we receive cash. Now, how much is that? The 2,000 shares times $15, the market value. That means that the company now reissued this treasury stock to the market at $15. $15. Then the repurchase stock is now reduced. Then you have to remember what was the cost of the repurchase stock. The repurchase stock for one stock per value is $11. So $11, how many shares now resold? 2,000. So 22,000 is treasury stock. Now the treasury stock from $110,000, this treasury stock should be reduced because the company resold from this treasury stock. Then what is this different? Now, additional paid in capital made by this the treasury stock transaction is the difference between two. So $8,000 is the additional paid in capital raised by treasury stock transaction. You don't put any number, any account here, gain or loss. Again, this is not the purchase, not the selling or buying procedure of the asset. This is not an asset. This is the issuance of a stock, reselling of a stock, which is equity transaction. So we don't recognize any gain or loss on this transaction. Now, my company additionally sold the treasury share, 1,000. Okay, the same procedure, same procedure. Oh, we want to use the cash account here. 1,000 shares times $8, and then treasury stock. Treasury stock. You have to remember how much value treasury stock we have to reduce. The $11 is the cost. And then how many shares we resold? 1,000 shares. So 11,000. Then, oh, we resold this share $8 per share, even though we repurchased the shares at $11 at cost. That means that we lose some amount, but we do not record any loss in the income statement. We just reduce additional paid in capital treasury stock. We reduce just equity amount. So the additional paid in capital, equity down on the debit side. So additional paid in capital treasury stock, we record by this difference. $3 per share times 1,000 shares resold. So the additional paid in capital, equity down. And then let's pass this journal entry transaction onto the TAccount. Here we want to put the cash, and then let's collect all the cash amount. Cash, we got the cash on the credit and the debit side, 30,000. One more time, debit side, the cash amount. And then the common stock, we have a common stock account on the credit side, $100,000, which is the par value. What about additional paid in capital common stock? Here also 900,000. Do we have any other transaction related to additional paid in capital common stock? No. And then what else? Now additional paid in capital treasury stock. Here now we put the name of stock on the credit, and we increased the 8,000, but we also decreased 8,000 additional paid in capital. So 5,000 is additional paid in capital treasury stock, the ending balance. Lastly, the treasury stock. The treasury stock we want to record. Treasury stock 110,000, and then on the credit side 22. We also have the 3,000 on the credit on the debit side. So the treasury stock on the balance is now, oh sorry, we have to put this 100 plus 3,000 minus 22. So here, okay, the 91,000. 91,000 is treasury stock balance. Is that right? Is that correct? Oh, no, I made some mistake. Treasury stock now. Okay, let's calculate one more time. Treasury stock 110,000. Now here, treasury stock 22. Now the treasury stock 11,000. So the treasury stock is 77,000 on the debit side. We still on hand. Then let's put this asset account for the cash. What amount is the ending balance? 928. And then equity, we have a common stock as a par value, 100,000. Additional paid in capital, common stock, the 900,000, and additional paid in capital treasury stock, now 5,000. And then this should be negative value because treasury stock is the contract account that reduce equity, the section equity category. So treasury stock should be in negative in parentheses. So this amount should be minus 77,000. That's why we record on the debit. So 77. Then let's make sure that if we balanced out total asset is equal to total liability and equity. 100 plus 900,000 plus 5,000 plus 77,000. Then we matched out. Then we have to record the information of the shares authorized and shares issued and shares outstanding. Here we have some shares schedule. On the shares schedule, authorized shares is how much was how many shares authorized? 10,000, 10 million. Now 10 million. These authorized shares is the total available the shares to sell, to issue when the company incorporate. So 10,000 out of 10,000, the shares issued. How do you get it? Okay, in the first place, the common shares, they raised 1 million with market price $10. So cash amount is about 1 million divided by $10 market price. So 100 shares is the shares issued. Now the shares outstanding is 100,000 issued shares minus shares repurchased. Shares repurchased, as you remember, how many shares repurchased? 10,000. There you go, 10,000. But the company resold these repurchased shares to the market, 2,000. So it is increased plus 1,000 one more time on December 1st. So 93,000 is the shares outstanding in the market. Then how do you get the shares repurchased? Just 100,000 the shares issued minus 93,000 outstanding. Or you can just calculate in this way. The repurchased shares in the first place 10,000 and then resold 2,000 and 1,000 finally. So 7,000. So the sum of this outstanding and repurchased is issued share. Then let's put the shares information on the balance sheet. So the authorized shares is 10,000. And then shares issued 100,000. Then shares outstanding, now we have at the year end at the fiscal year end of the company is 93,000. Then here the treasury shares with the cost information $11. The shares now, the 7,000 shares is the treasury stock. Okay, and then the finish. So again, the point, we don't have any transaction related to income statement, any gain or loss. We just increase or decrease this equity by recognizing transaction of a treasury stock. Okay, see you the next video clip.